All right, everyone, welcome to our webinar. Our webinar is Insurance Protection 101, how to secure your future, your family, and leave an amazing legacy. How would you love to do that? I'm Barry Brooksby, founder of Focus Wealth Group, and I'm looking forward to sharing a ton of content with you tonight. And honestly, I want to do this because there's a lot of myths and misconceptions out there around life insurance. And I want to dispel a lot of those myths tonight. People believe that life insurance is a burden, life insurance is a cost, life insurance only helps me or my family when I die. And most of that, if not all of that, just simply is not true. Great job for being on the webinar. It shows that you have a desire to learn. You're investing in yourself, which is fantastic. And I hope that you have a pen and paper because I'm going to share with you a lot of content. I've put time into this and a lot of numbers and illustrations. Again, I'm going to dispel a bunch of myths. I think you're really going to like it. So take some notes, little bio on me. I'm 18 years in the financial services. I've got clients all over the country. I actually have clients in 49 of 50 states. And I am the founder of Focus Wealth Group. I'm an infinite banking practitioner. Just some housekeeping. As we're diving into the webinar, this is obviously digital and virtual. You could be on your cell phone. You could be playing a video game. You could be looking at Facebook. So I hope that you're going to pay attention. And I would encourage you to please turn off anything that's distracting you. Shut down Facebook, shut down your cell phone. Just put away any of those distractions and really stay focused because, again, this is about you educating yourself, gaining financial literacy, and it will help you to propel forward in a much more abundant way, creating wealth, seeing opportunity that maybe you've never ever seen before. So this is really today you investing in yourself to have a better future. I believe that. I fully believe that. I do the same. I invest in myself every single day and it pays dividends. Let's dive in. I want you to look at this picture. Have you ever been standing on a subway in a big city or on a tram, maybe at the airport, and the ride on that tram or subway is really shaky? There's either quick stops or fast acceleration. You feel unstable. You know, you're moving around, you feel unstable, like you could fall down or something. Well, what do? You usually grab on to a handrail or a bar. And why do you do that? If you're feeling unstable, why do you grab onto the bar? And it's because you're trying to gain security. You know that the bar is secure, therefore, by grabbing the bar, you can be secure. The first little tagline of the webinar is how to secure your future. I really want to focus on that because, frankly, most Americans in retirement don't have a secure future. Most Americans are completely uncertain of what's going to happen in retirement or 10 years from now, 20, 30, 40 years from now. There are ways to secure your future. Just like holding onto the handrail, you gain confidence, you feel stability, you have peace of mind. These are the things we're going to talk about tonight and go through. But first, I'm going to pull up a whiteboard. I want to share this idea just to kind of introduce something very simple. This will take just a couple minutes, but it's really important that you understand this because I did call this Insurance Protection 101, so I want to go through some 101 detail here. There are three basic types of life insurance out there. And sure, there's some varieties, but three basic types of life insurance. The first is term insurance. And a lot of you have term insurance. Term insurance, I want you to think about this like you are renting a home. That's how I compare it. It's like renting a home. When you're done renting the home or using the term insurance, there's nothing to show for it at the end of the term. You've used it for 10 or 20 or 30 years, and if you're still living, the term insurance goes away, that death benefit is gone, there's nothing there for you. You could get this in a 1-year term, you could get it in a 10-year, a 20-year, a 30-year. And what's so interesting about term insurance, it has a low premium. But did you know it is the highest cost insurance out there? Now, how could that be? If it's got the lowest premium, Barry, how could it be the highest cost? It's because if you insure your entire life with term insurance, you will pay higher costs for the coverage. What happens when a 20-year term insurance goes away and you still want life insurance? You've got to go reapply. And now 20 years later, the costs are higher, maybe double, triple, quadruple. And what if your health has declined? Now those costs are even higher. So although it has the lowest premium, it is the highest cost of insurance out there, which is just so ironic. It doesn't seem like that would be the case, but it is. Now, there is one type of term insurance that I like, and I own this type of term insurance. It's called convertible term, which means that you can convert it to one of these other two types of insurance as I'm going to share with you here. So again, think of term insurance like renting a home. The next type of insurance is called whole life. And whole life insurance does what it says. It covers your life, your entire life. And whole life insurance is like owning a home. It has equity, it's ownership. And the reason it has equity or ownership is because whole life insurance also has within it cash value. This is like a savings account on steroids. You're getting a guaranteed rate of return plus earning a dividend. You have equity just like you would in your home. And that equity is growing and growing every year, guaranteed. So we're going to talk about a couple of those guarantees because whole life insurance is guaranteed. This is really important. What's guaranteed? Well, first off, there is a death benefit that is guaranteed. Second of all, the premium is guaranteed to never increase. That's what I mean by that. The premium is guaranteed to never go up. So if you start a policy, a whole life policy at the age of 30 or the age of 40 or the age of 50, when you turn 60, 70, or 80, the premiums never go up. Now think about that from an inflation perspective. If you start a whole life policy at the age of 40 and you're paying premiums at 60, it's the same premium amount that you started 20 years earlier with no inflation. Pretty cool how that works. And the third thing that's guaranteed is the cash value. Cash value that I mentioned earlier, it is guaranteed. It's guaranteed to grow every year. It's guaranteed to be there, which means you have some security. You have some predictability and certainty there. The other thing about whole life insurance is you also have flexibility. Well, what I mean by that, you can actually change the premium amounts. If you're putting $1,000 a month into a policy and you have a hardship and you need to reduce the premium down to $500 in a given month, you have the flexibility to do that, at least in the policies I design. You also have the flexibility, what if you have a good month, you can take that $1,000 premium and bump it up to say $1,200 a month. So flexibility in the premium, which is really important. You also have flexibility. There's a myth out there about whole life that you have to pay the premium your whole life, and that is not true. So the other flexibility is that you could actually stop funding a whole life policy in 10 years or at age 55 or age 65. That's up to you. And you don't have to know when you're going to stop the premium payment. You get to decide in the year that you want to stop paying the premium. So I love that idea of flexibility. The third type of life insurance is universal life. Now, universal life, it's a relatively new product. It's only been around since the mid-'80s, whereas whole life insurance has been around for 200 years. Universal life is also like owning a home. There is equity because of cash value. The problem, however, with universal life is that there are increasing costs. When universal life first came out in the mid-'80s, it was built on the chassis of annual renewable term insurance. And what that meant was every year you got older, your cost of insurance went up a little bit. Well, imagine what those costs would be in your 60s, 70s, or 80s. It gets very expensive. So unfortunately, although there is flexibility, in most cases, there are not guarantees. And that's a problem. So what that means is that it's potentially possible that your death benefit is not guaranteed. Your premium is not guaranteed. It could go up. And your cash value, you could lose it, or it could be depleted. The only way around this in a universal life policy is if you have a GUL, which is a guaranteed universal life policy, or you've added a rider called a no lapse guarantee. So you have to be aware of these different types of insurance and what you're trying to accomplish. Now, when I say universal life, understand there's variable universal life, there's indexed universal life, and there's also just traditional universal life. They all fall into the same category. All three of those fall into the same category. So I want to show you some examples of what I'm talking about, because some of you might have universal life insurance. And, I work with agents all across the country. That's one of the things I do. I'm a coach for agents across the country because my expertise, I've done this 18 years, been virtual for the last 7. So I coach other agents across the country. And what I've learned in the last 7 years is that most life insurance agents, to be candid, don't know what they're selling. And I'm not being mean. I'm just being candid with you. Most life insurance agents don't know what they're selling. However, universal life is a really hot product right now. Why? Because an agent can put in a rate of return and show that rate of return all throughout the cash value, and it looks incredible, but it's not real. Now I'm going to show you what I mean. So with that said, here comes our first illustration. So what you're going to see here, this is a variable universal life policy. And there are 3 columns we're going to look at. We're going to look at this hypothetical column here of a 0% return, right? If the policy didn't earn any returns in the market. And then here, if the policy earned a 4% return. And then over here, this is if the policy earned an 8% return. Now keep in mind, this is every single year. So I want to ask you a question, even in this example right here. Does the market, the stock market or mutual funds, do they earn 4% consistently every year, or over here at 8%? Do they consistently earn 8% every single year? No. We know there's volatility. It goes up and down. Now, it might average 4 or 8, but the problem with these universal life examples is that it's as if the policy earned 4% or 8% year in and year out without ever having a down year. And frankly, that just does not happen. So I want you to be clear about that. So in the 0% example, that's guaranteed, 0% is the floor, that's what's guaranteed. We see down here, we've got my arrows here, we see that if that were the case, this policy would expire after the age of 79. That's why I have this circle here, that the account value is gone, the surrender value is gone, and the death benefit is gone. And by the way, this example, $50,000 a year, 13 years, that's $650,000 gone into the policy. So if you set aside $650,000, would you want your cash value and your death benefit to be gone after the age of 79? If your answer is no, raise your hand. Yeah, if you want to know that your cash value is still going to be there, That's important. Well, look at this. Here's 4%. Say 4%, same 650,000 that's gone in. Even with a consistent 4% return year after year, we see that at the age of 86, nothing's there. Cash value's gone, death benefit's gone. And if you happen to get 8% every year, which I've never seen ever, and I've done this 18 years and I've analyzed charts, 50-year history, 100-year history, this has never happened. We see that if it did, you're still done at the age of 99, right? So if you pass away and you see you might get some death benefit, the death benefit's depleting over here too. All right, that's first example. Second example, another company, okay? Another company. I want you to see what's going on here. This is a universal life policy. And what we see here is about $13,400 going into the policy. This is an existing contract. I didn't sell this policy, but this person is a client of mine, and this is a policy that they had before. And so they had had this policy for 12 years. We see at that point, $13,400, the cash value is $191,000, but there's only $180,000 that's available called net surrender cash value, because the life insurance company will charge you if you take your money out and you don't get everything that's in the account value. That actually doesn't equalize until here after the 20th year. You see the 261 in cash value is now the same as the net cash surrender value. Well, here's the problem. Look at this. The same 13,000 over here on the left is going in, but look at the account value and the net cash surrender value. The dollars are going down. Why are the dollars going down? Because the cost of insurance is increasing. Just like I showed you on the whiteboard earlier, universal life insurance has increasing costs unless you've purchased the guaranteed rider, which most people don't have. And usually the guaranteed rider on a UL goes away after 20 years. So it's gone. That's a big problem. Okay, third example, different company. Okay, I'm using 3 different companies so you can see what's happening here. In this example, it was showing a 4.5% rate of return year in and year out. And again, this was a person that had a policy in force. It had been in force for 14 years. They were paying $20,000 a year. And what they were getting for this $2 million death benefit was, if they put the $20,000 in year 15, that was the last year that the $2 million was guaranteed. Year 16, even if they put in another 20 grand, the guaranteed death benefit is 0. Okay, just showing you here what's on the illustration. The reason for the loss of death benefit and loss of cash value is because of the increasing cost of insurance. Not only is there a premium expense charge of 10% on the premium, which, by the way, do you see how this jumped up to $42,000 a year? In order to keep that $2 million death benefit going, the life insurance company now was asking for 42 grand a year instead of 20,000 a year. And the cost of insurance is going up every single year. Just like I said earlier, UL, Universal Life, has increasing costs. So you've got to be aware of these types of policies, all right? And then we get down here, and I mean, just ridiculous numbers. 35 grand for costs, you put in 42. Most of the money is covering the cost of the insurance, and then here it gets ridiculous, and cash value is being depleted. All right, so with that said, I'm going to come back to the whiteboard here just for a minute. We're going to look at this one in the center, whole life insurance. Now, this is the product that I primarily sell because I want all my clients to have security, to know what's going to happen in the future, to have predictability. So I've pulled up also a whole life insurance policy right here. And I want you to notice that in these columns, we have a guaranteed cash value and a non-guaranteed cash value. I'll explain these two. The first thing I want you to understand is in the guaranteed column of cash value, we look at PUA cash value. This column, no matter how old you are, never depletes, right? So in our 60s, we see that the cash value is growing. In our 70s, we see the cash value is growing. Even in our 80s and 90s, the cash value is always growing. It is guaranteed to grow year after year because there are no increasing costs. Again, very important. However, the guaranteed column of cash value does not include the dividend. And whole life insurance companies, the ones I work with, have paid a dividend every year since inception. So we look at this column of cash value over here. It's not guaranteed because the dividend isn't guaranteed. The rate of return is guaranteed, but the dividend isn't guaranteed. So the dividend can fluctuate, but it has been paid every year. This company's been in business 140 years. Most of the companies I work with have been in business over 100 years. Once a dividend is paid in a life insurance policy, a cash value life insurance policy, the dividend is locked in. It can never be taken away. So that's important to know too. If you have a stock and it's a dividend paying stock and you reinvest the dividend back into the stock and the stock price loses value or goes down, what can potentially happen to the dividend? You could lose it. In this case, when a dividend is paid in a cash value insurance whole life policy, it is locked in. It will never, ever be taken away from you. Okay, I want to pose a question here. How good is cash value life insurance compared to other types of investments? What do you think about that? How good is it really compared to other types of investments? Because I hear this all the time, Barry. What if I put my money in a mutual fund or in a stock or I buy some bonds? How's it going to compare with me putting that into a cash value insurance policy? Well, let's see. Let's find out. So what I've done in this example right here is I've simply taken the whole life numbers of this illustration right here and put it into a truth concepts calculator. And what I want you to notice on this total annual outlay column, I'm showing $18,000 a year, which is $1,500 a month. But I'm only showing funding for 25 years. And starting at age 61 or the 26th year, I'm showing no more premiums going into the policy. Done. No more money going in. So check this out. We look at this, and up to this point, with $18,000 going in for 25 years from the age of 35 through the age of 59, that's 25 years, the cash value is $749,000. So let's do some quick math. If we take $18,000 and we times it by 25 years, that means $450,000 went into the policy, and there's $749,000 of cash value. That's $749,000 because it's in a life insurance policy. As long as the life insurance policy stays in force until you pass away, this money can be used completely tax-free. Okay, think about that. $749,000 completely tax-free. As we look at the rate of return on this cash, it's as if you would have earned 3.72% every single year, not just in the 25th year, but every single year. That's what this means, the internal rate of return on life insurance cash value. See, and a lot of people believe that a life insurance policy is only going to earn 1% or 2%. That isn't true. It is so much better than a savings account or a CD and even bonds in most cases. And you're going to see here in a minute that it will even outperform most stock market investments. But I want you to look at the math here. If I pull up this calculator, right here, this rate calculator, and I put in $18,000 on our annual payment, and we do that for 25 years, and the future value is this $749,201. Look at that, 3.72%. So again, it's as if you would have earned a tax-free 3.72% rate of return every single year. Even though we see in year one the cash value is $12,590 and we put in $18,000, that rate of return is as if you would have earned 3.72% every single year. So that's, again, really important to know. Let's take this out to the age of 70. There we go. Because I want you to see what's happening here. We're done funding after 25 years. So at age 60, there's no more money going into the policy. But look what happened to the cash value. It grew from $749,000 to $782,000. There was roughly, $33,000 worth of growth, $32,000 worth of growth, and you didn't put any more money into the policy. The next year, it grows again. Next year, it grows again. Next year, it grows again. So as we take this out to the age of 70, we see that the account value now is $1.19 million, almost $1.2 million. And the rate of return now through the age of 70 is 4%. That's why we see this number change here in the bottom left-hand corner. So now what I'm going to do, I'm going to copy these numbers with all the decimal points. I'm going to paste it up here in an alternate account. That what if you could earn or would earn 4% in your alternate account and you wanted to go out and put this money somewhere else? And I want you to think about this too. This 4% that I'm highlighting here, where today can you get a 4% safe, secure rate of return? Okay, we have to compare this to accounts that meet that criteria. So a savings account is safe, but you're not earning 4%. A CD is safe, but you're not earning 4%, and that money isn't liquid. Okay, remember in this life insurance policy, all this cash value is liquid. You have access to it. It's like your own banking system. So you put money in a 5-year CD at 2.5%, you're getting 2.5%. It's taxable, but the money's also locked up. It is not liquid. Bonds, same thing. You might find a 4% bond, could be taxable, could be a tax-free municipal bond. But again, that money is not liquid. It's tied up. And what you need to know is most life insurance companies out there, they're purchasing bonds anyway. And they're usually getting better rates than you are because they're buying in multi-million-dollar tranches. So you can get the effect of a bond in a life insurance policy, plus you get the benefits of a death benefit, which we haven't even talked about yet. All this over here is an asset to you and your family, and you have liquid cash value. So let's do this. Let's compare this to an alternate account. And the alternate account, if it were earning 4% every year, again, would grow to 1.19 million. But if you're in an alternate account like a bond or a mutual fund or a stock, those things are taxable. So we're going to look at the tax rate. And we'll use, in this case, we'll use Trump's new tax plan. We'll use a 32% tax rate. And watch the number change here down in the bottom. What that means is that you would have to earn a 5.88% rate of return in your alternate account, your stock, your mutual fund, or your bond to equal 4% of the life insurance policy. Okay, but we're not done. If you're in a mutual fund or a stock account, right, a brokerage portfolio, there's going to be a management fee. I want to pull something else up here too. The management fees in a mutual fund, they're not what most people think. You might think 1% or 0.5% or 1.5%. That just isn't true. So I wanted to pull up this Forbes article real quick so you can see what's actually going on. And this is titled "The Real Cost of Owning a Mutual Fund." And the author here goes through the expense ratio, the transaction costs. We see here tax costs, not just federal and state tax, but these are tax costs that you pay inside of the mutual fund itself. Also a cash drag cost, soft dollar cost, the advisory fee, and look at the summary here. So in a non-taxable account like a 401k or IRA, that mutual fund expense is 3.17%. If you're in a brokerage account, non-qualified, look at that. average taxable account, 4.17%. I'm not going to get that crazy with it over here. I'm going to show a 2% management fee. And this also could include some of those fees I just showed you in the article. Transaction costs, soft dollar cost, marketing fees. There's so many fees in these funds, they're just outrageous. And if you want third-party information to back up what I'm saying, just shoot me an email or put a question in here and I'll send you some stuff. By adding the management fee with the taxes, look at this, 8.04%. What that means is if you had a mutual fund, a stock, or a bond, you would have to earn 8% every single year, okay? Never having a down year. A consistent 8% return every single year to match a 4% tax-free earnings rate in a life insurance policy. But guess what? We're not done. What do most people do that are investing in the market? Have you ever heard this before? Buy term insurance and invest the difference. That's so popular. That's what most financial advisors teach out there. Buy term insurance and invest the difference. Well, where do they want you to invest the difference? With them, in the market. No wonder. So this person more than likely would have term insurance. So we got to pull that cost in here too. Now I've already preloaded this. It is I'll show you right here, life insurance inputs. It's $1 million term insurance death benefit for 30 years, and the premium's about $1,200 a year. And at the end of 30 years, the term insurance goes away. We want to cancel it, 64. So 30-year term from age 35 to 64, about $1,200 a year. Now look at the rate of return. See, if you have a whole life insurance policy and you're sitting on a $1.3 million death benefit over here and it's growing as you get older, there's no need for the $1 million term insurance. You're covered. If that's all you were trying to accomplish, right? If all you wanted was $1 million of death benefit, you've accomplished that over here with the whole life policy. Now, in your alternative investment, you would have to earn 8.5% every single year, year in and year out. Okay, I've got to just hammer that home. It's as if you never had a down year. Again, the market has not done that. How good is life insurance? How good is cash value life insurance compared to what else is out there? It's phenomenal. It's incredible because I don't know any investment in the market that is earning 8.5% every single year. It just doesn't happen. And not only that, if you pass away with your stock market investment and your account portfolio is 1.19 million, what does your family get? 1.19 million. But if you pass away with this policy, what does your family get? 1.9 million. Tax-free. There are other benefits to life insurance besides this incredible rate of return I'm showing. We have to look at this whole picture. Remember, it's called life insurance, not death insurance. I teach and share and show people the living benefits of life insurance. Yes, there's a death benefit, but there's so much more to it. It is called life insurance for a reason. We want to use these living benefits to our advantage. And I'm going to show you another way that we do that. I want you to think about this. I'm going to draw these two pools. Okay, think of these as pools of money. On the left, we have the stock market pool of money. And again, these are things like a 401k, an IRA, mutual funds, could be a brokerage account with stocks, bonds. Now, what happens in retirement when you're sitting on that pool of money and that's all you have? In retirement, are you more aggressive with your investing or are you more conservative? You all know the answer to this. You're more conservative. You don't want to take risk because in retirement, it's more about principal preservation. We want to protect what we've earned. So more times than not, people are investing in things that are earning lower returns because they want safety. They want to make sure that if there is a downturn or a crash or a correction, they're not going to lose a ton of money. But here's the other problem. What if you're banking on a certain amount of income in retirement from your stock market portfolio and the market crashes? You still need the same amount of money to live on. But if you take money from a negative stock market portfolio, you now cause double pain to your overall value because you're now taking money out of a negative account. And I'm going to show you what that looks like here in just a minute. Whereas on the right-hand side, if we now look at this as the life insurance portfolio and specifically cash value, because remember, the cash value in a whole life insurance policy is guaranteed to grow every year. There is no market volatility. So what we have over here is a guaranteed potential income. Here's what that looks like. The way we want to look at this is we want to take market history from a time when a 12% average rate of return happened. Now, this doesn't happen in the market. This is the S&P 500 from 1970. I'm going to blow this up so you can see it bigger. 1970 to 1994. So I'm taking a 25-year history. This is the S&P with dividends. Investors don't get dividends, not in the S&P 500. That goes back to the money managers. So the more accurate column is this over here. But the reason I'm using this is I needed to find some years that showed roughly an average of 12%. Now, although the average is 12, I want you to look through this column of numbers right here. Do you see a 12 anywhere in here? The answer is no. An average rate of return, if you go back and watch some of my prior videos, prior webinars, an average rate of return is completely meaningless. All it is math. It's adding the numbers up, divided by the years, we get this number. But the reason I'm doing this is I want you to see this. If I take a 25-year history and I put in an earnings rate of 12%, and let's assume in retirement you have $1 million portfolio. And let's call this age 65. And now you're ready to start taking income. And if you listen to Dave Ramsey or Susie Orman, they'll tell you, hey, you're going to earn 12% in your mutual funds. And so that means that you could take out 10% every year, right? We're coming back to what I shared with you earlier as I drew this out. This left-hand pool of money, take money out of your stock market investments for retirement income. That's the idea. Well, if we take 10% out, which 10% of $1 million would be $100,000 a year. So I'm going to do minus $100,000. And you're earning 12%, everything's going to be wonderful, right? No problems. Matter of fact, at the age of 89, 25 years later, the account value is still $2 million. You're feeling pretty good. You could spend and keep enjoying that money or give it to your heirs if you pass away. But here's the problem. I'm going back to what I mentioned earlier. This earnings rate column, does the market consistently earn 12% every year? And the answer is no. So as we look at this market history, what I shared with you earlier, that's why I pointed this out. There is no 12 in this column. So what I'm going to do is I'm going to copy and paste these numbers. By the way, look at some of these great returns, 18%, 23%, 22%, 31%. I mean, there's some awesome numbers in here. I'm going to copy and paste these 25 years of history. Now we're going to put these into the real life situation. I'm going to paste those rates right into the earnings rate column. And look what happens. If you continue to pull $100,000 out of the account for your income, look what happens in year 4. The market went down 14%. You pulled out 100 grand, you lost 130,000. That was 230 depleted. Your $1 million portfolio has now been eroded to $776,000. Ouch. And the next year, the account loses 25%. You still need your $100,000 of income to live on, but look, $175,000 of additional losses. What was $1 million just 2 years earlier is now $500,000, and you still got life to live. So if we run this scenario, really seeing what's happening with the market, the ups and downs, the volatility of the market, you get to age 77, 13 years in, you're out of money. You're done. The next year, it's gone. You can't go negative 57,000. There's no more money left. So the way that we insure against this to secure our future is when there's a down market or the year after, if you're suffering those losses, guess what? You don't take money from the stock market account. You don't want to add salt to that wound. You just got hammered with 14% losses or 25% losses. Now you take your $100,000 of income from the life insurance cash value. See, the life insurance cash value is giving you a hedge against market losses. It's that pool of money that's secure, and that way you can potentially never run out of money. And we've seen this used. Okay, this is one more example of a life insurance policy benefit. You can use this as a buffer. Okay, another thing I want to share. You guys remember these when you were a kid? Getting that hall pass, the permission slip? I remember being in elementary school and having a permission slip given to me by a teacher so that as I was walking the halls, if another teacher saw me or the principal, I wouldn't get in trouble. Those are kind of fun experiences to go back and think about. And how did you feel? How did you feel getting a permission slip? It was like awesome. Like, you're like, well, I'm the hero. Yep, I'm cool today. I've got a permission slip. Well, a life insurance policy gives us that same feeling and the same permission. By having a cash value life insurance policy, you have a permission slip to spend and enjoy all the money you make while you're alive, because there will be a death benefit that will come in and replace everything that you've spent. Here's what I mean. We're going to now look at what's called a distribution calculator. This is now you taking money out of a portfolio, perhaps, in retirement. And what does this look like? So what I'm going to use is I'm going to show that in retirement at the age of 70, you've got $1 million. I'm showing this million, everyone, because it's just easy to think about. And if you're following the traditional financial planning advice, you're being told that in retirement, you should live interest only. Only live on the interest, don't touch the principal. It is such a popular delusion. It's such a popular myth. That's what most financial advisors are telling their clients. And they're doing that because they still want to continue to manage your money while you're retired. So all you're spending is your interest. So we're going to show a 4% earning rate here. And one of the reasons why, again, is when you're in retirement, you're going to invest more conservatively. But also there's another rule out there I'm going to share with you called the Monte Carlo rule. And the Monte Carlo rule simply says, well, the old rule used to say that you could spend and enjoy 4% of your retirement income. And when you pass away, which is based on mortality, you would have $1 left to your name. So you see here, this was the old rule. The 4% rule isn't the 4% rule anymore. Now it's about 2.8%. So you see here, if you did spend and enjoy 4% of your portfolio, if you live for 30 years in retirement, you have an 85% chance of success of not running out of money. Now, I don't know about you, but I don't want an 85% chance in retirement of not running out of money. I want a 100% chance that I'm not going to run out of money. I don't want to go back to work, which we see a lot of people doing at 85 and 90. I don't want to do that. Now, I love what I do, so I hope I'm doing something, but you understand my point. I don't want to be forced to have to go back to work. If you're pulling 5% from your portfolio 30 years out, you have a 60% chance of making it. That means 40%. Good luck. New Monte Carlo is you pull 6% of your portfolio out in retirement, you only have a 30% chance of making it 30 years. So the new rule is about 2.8%. We're showing 3 here. If you pull 3% out, 30 years, you have about a 98% chance. 2.8, pretty much you're guaranteed. You should be good to go. So that's one of the reasons I'm using the 4% rule here. And you're going to see me change some of this here in a minute. Okay, I'm trying to be fair about this. But because the traditional financial planning advice is interest only, and we run this for, let's say, 25 years, we'll go age 70 to 95. We see that on $1 million portfolio, that's $40,000 of income a year. But it's in a brokerage account, or it's in an IRA. That money's taxable. So we have to pay the tax. Now, this is as if it's in a brokerage account, only paying tax on the gains, no principal, only the gains. So we pay the tax. How do you want to live? 35 grand a year, you're worth $1 million. That's all the income you get. How does it make you feel? Think about that. What you're seeing right here is traditional, typical financial planning advice. Live interest only. But here's the problem. This $1 million that you have over here, it's your money. And you're going to pass away at some point. Well, when you pass away, guess what? That $1 million is going to go to your heirs. It's going to go to your family. It's your life insurance policy. Whether you like it or not, you just spent $1 million for $1 million death benefit. Do you understand that? It's $1 million. It's your cash. And you just paid $1 million for that $1 million death benefit to go to someone else instead of you. So what I say is there's got to be a better way. And that's why we use the permission slip example that I shared a few minutes ago. Having a life insurance policy truly is a permission slip for you to spend and enjoy your money while you're alive. So now let's look at distribution 2. This is age 70 with life insurance. But instead of $1 million, you had to buy some life insurance. You had to spend the money on some life insurance. And so what you did is you ended up purchasing $1 million death benefit to cover the $1 million that you had. And it cost you over time about 10 grand a year for 25 years. So this is now $750,000. And we show an earnings rate of 4%. But here's the difference. Because you know you have $1 million death benefit out there, you can spend and enjoy all of your own money, no guilt. It is your permission slip to enjoy that money while you're alive. So you pay it down. You spend principal and interest. Instead of only getting income of $35,000 on the $1 million, you get income of $44,000, $9,000 more dollars a year. And check this out. The income is going up. Why? Because you're pulling principal and interest from the $750,000, you're paying less tax. You're paying less tax because of principal and interest, where this over here was all interest. Well, what's the net effect? When I click the compare button, because you had this life insurance policy and $750,000 was spent down instead of $1 million, you were able to spend $1.15 million versus $889,000. Because you had a life insurance policy as a permission slip. You spent $264,000 more on less money. $750,000. gave you $264,000 more spendable income. Well, what's the net effect? The net effect, I need to pull this up. Here's that $1 million death benefit that you purchased that I said earlier, $10,000 a year right here, but you only did it for the 25 years. So when we look at that calculator and we run you out to the age of 95, we look at the death benefit at 95, it's a $1.5 million death benefit. Not only did you get to spend and enjoy $264,000 more dollars, you also left a $1.5 million death benefit to your heirs. Not just $1 million over here, $1.5 million. So again, we're talking about the power of life insurance. In the last few minutes that we have, I want to wrap up with this idea. There are ways to use your death benefit while you're alive. I hope I've been really clear about that tonight. Super important. These are living benefits. And I just shared that one with you. A permission slip to spend down your assets. 2, pension maximization. You know, a lot of people in retirement, they get a pension, but they take the option for less income to cover a spouse. It's actually better to get the most pension income you can get and have a life insurance policy to make up the difference, that if you pass away, then your spouse can get more money. So that's another conversation, but pension maximization gives you more income now and a death benefit for heirs. You can also take the dividends from your life insurance policy in cash. You don't have to reinvest those. So in retirement, if you want those dividends coming to you from the life insurance policy, totally possible. How about a reverse mortgage? You know, I like reverse mortgages in most cases because it allows you, one, to free up a payment, or if you have a ton of equity in your house, you can put that equity to work. Well, a lot of people have fear. Well, if I've got a reverse mortgage and now there's going to be, you know, more interest on the back end, or what are my kids going to do if they want the house? Well, guess what? If you have a life insurance death benefit that will never go away, that life insurance death benefit can pay off the reverse mortgage. It's an awesome strategy. And then lastly, you could actually sell your death benefit to a life settlement company. You could sell your death benefit to someone else and cash in while you're alive. So with that said, everyone, thank you for attending the webinar. We've talked about how to secure your future, your family, and leave an amazing legacy. You can do this. If you've liked what you've seen in the webinar and you would like to learn more and find out what's possible, click below to schedule a call with me. You can also send an email. I encourage you to take the next step, find out what's possible for yourself, see your own numbers, and how infinite banking can dramatically impact your life and your financial future.